I'd like to call this work session order. This work session is on AO 2017-154. It's item 14A on the agenda on Tuesday. Let's go around the room and dare sells for the record. Chris? Fred?
Sir? Here.
Thank you. Eric?
Felix Serra.
Dick Training?
Forrest Dunbar.
Pete Peterson.
Suzanne
Jim
Lefras.
Steele.
Okay.
Brian Robbins.
You've got a copy of ordinance in front of you. Who's going to be talking about it? You are? And John Wilton's on the phone. Sorry, John.
This is Brian Robbins. I have a short presentation.
Go ahead, sir.
I'm going to jump to, this is a very short presentation to try to explain the impact of the change in the residential exemption. It's a fairly complicated topic. I'm going to try to boil it down to some simple, as simply as possible. And the first thing that I'd like to talk about is the fact that some of the impacts are counterintuitive. When you, let's see, looks like my clicker's not working. So it would be reasonable to assume that if you increase the residential exemption by $30,000 from $20,000 to $50,000, you would get a savings for most homeowners of about $470. You'd get that by saying, well, I have $30,000 of additional exemption, multiplying our current mill rate of 15.66 times that exempt amount, and you would assume that you're going to save about $470 on your tax bill. Reasonable assumption, but it's wrong.
Of course.
And so I'm going to try to explain why that isn't the case. There are very few people that will get that $470 savings. Most people will get something somewhat less than that. So I'll try to explain why that is, and then I'm going to walk you through what will really happen by property type or by value of property and property type. So to start with, I think it's maybe worth doing a quick review of sort of what exemptions do and why they behave the way they do. The really simple sort of analogy for an exemption is if you imagine 4 people going to lunch. If they have a bill of $80, you split that bill 4 ways. Everybody pitches in $20, and we're done. Now let's just imagine that one of those people has a birthday that day. The other 3 people want to treat that person to lunch. So what happens? The restaurant still wants to get paid their $80. So the other 3, the remaining 3 who didn't exempt the birthday boy, have to pay more, $26.66, I think. So an exemption works about the same way for the municipality. When we exempt additional property, we don't lower our budget. The Assembly's going to pass a budget the same amount that they would have otherwise. So we still have to collect the same amount of money to pay for the services, to pay the bills. So we collect the same amount of taxes. We collect it from the non-exempt property. And here's where it gets really sort of tricky when you're talking about a residential exemption. Exemptions shift the tax burden to non-exempt property. Now, they don't necessarily shift the tax burden to other non-exempt property. In the case of a residential exemption, for most people at least, let's just use an example of a $200,000 house. If you have a $200,000 house, we increase the residential exemption to $50,000. Well, we still have $150,000 of taxable value there. So not only does this exemption shift to other taxpayers, but it shifts to the remaining $150,000 of taxable value on the house. So the homeowner then is sitting on both sides of the equation at that point. They're saving money because of the increase in the exemption, paying a little bit more on the remaining taxable property, and so it sort of dampens the savings that you might expect. That's why we don't get the full $470 of savings that we might have expected when we just use that simple calculation. So, in the case of going out to lunch, well, we just divide by 3. Take the bill, we divide by 3. That's how we find out what the new bill is. With the municipality, it's a little more complicated than that. We have to calculate a new mill rate, and this is just a really simple example of how that might work. If we had $1 million in taxable value at our current tax district 3 mill rate of 156. we're gonna collect about $15,600 in taxes on that taxable value. If we increase the amount of exempt property, our tax base drops, and so let's just say $900,000 of taxable value now. We still have to collect that $15,600 because we still have to pay the same bills. So our mill rate goes up. In this case, it would go up to 173, and we collect the same amount of money on the $900,000 in value. So that's what will happen if we raise the residential exemption, is the mill rate will adjust upward and compensate. This slide shows you how much the mill rate will rise. And on average, it's going to be about 3.9% increase in the mill rate. Along the bottom, it shows the increase in mill rate for all the tax districts. There's a little bit of variability here because it really just has to do with the ratio of exempt property to non-exempt property. That's why you get the variability. But it's all within a 3.2 to 4.3% increase in mill rate. And so that drives what I'm going to show you as we walk through the impacts for various property types.
Mr. Croft.
Just real quickly, I don't want to interrupt the flow, but that's 4% of the mill rate. That's not 4 mil points.
Exactly. Otherwise, we'd have a mill rate of what, 30, 45 mils. So, no, it's just 4% increase from the 156. So,
Thank you. Go ahead, sir.
yes. So let's take a look first at just residential properties that already have a residential exemption.
Now, Mr. Croft? Go ahead. Chris has got a comment, but he can wait a few minutes.
Okay. So as we look at these, as we look at all the remaining slides, it's important to keep in mind this slide. This slide shows the. It's not working. This slide shows the number of properties in the various value ranges for residential properties. So the majority of our residential property falls in the $300,000 to $400,000 value range. We have a fair amount in $200,000 value range and on up to about $500,000. So when we look at the impact, remember that's the majority of our property. And if you look at this chart, you can see that the $300,000 to $400,000 value range is going to see the largest amount of savings. About $250 to $300 for properties in those value ranges. When you get above about $900,000 in value, you start to see an actual increase in value. Even though you get the increase in the exemption amount, your tax bill overall is going to rise. Now, the most expensive residential property that we have in the municipality is about $2.7 million. So you can kind of interpolate there as to what the increase in the tax bill would be. This shows that same information just with more detail. We've highlighted the $300,000 to $400,000 range where most of the properties occur. You can see 263, 322 in those price ranges. That's about a 4.4 to 7.5% decrease in your tax bill for those property owners. Now, if you look down at the $2 million price range, those folks will see an increase in taxes of about $681. That's a 2.2% increase.
Let me interrupt you for a second. I'll have Rose send me members a listing that basically breaks it down, because people are going to ask us, what are we going to save if this goes into effect? If your house is at $200,000, you're going to have a reduction of about $219. $300,000 about $322, and a $400,000 house reduction about $263. So I'll have Rose send out to everybody in that format. So when people call you, you can tell them.
And
Go
we,
ahead,
and we
sir.
did present a.
I know Rose
Okay.
has a nice, handy-dandy, easy one to work on.
All right, great. All right, so that's residential properties with only a residential exemption. Now, when you look at properties that already have a senior citizen or a disabled veteran exemption, that's a $150,000 exemption already, and a residential exemption, things change. And they have less remaining taxable value in their property, so they get a bigger savings. They get closer to that $470 savings that we might have expected. In the $300,000 to $400,000 range here, you can see that their savings is closer to $400. This shows it in more detail. And if you look at the folks with $200,000 house, that's the one group that actually gets that expected $470 savings, and that's because they already have a $170,000 exemption. When you increase it by $30,000, they're fully exempt, so they don't transfer any of the tax burden to the remaining taxable property. They get that expected exemption. Everybody else gets something less. This is everybody else. This is commercial properties, maybe second homes, properties, rental properties, any property that doesn't have a residential exemption of any kind on it. And the story is a lot simpler here. Their tax bill goes up by whatever the mill rate increases. This just shows tax district 3, and it's the tax amount by value. Just for the record, the most valuable commercial property in the municipality is around $100 million. So you can extrapolate from that what their increase in tax bill would be. But this shows it in more detail. Everybody increases by 3.8%. The amount is strictly a function of the value of the property. The majority of commercial properties are in the $500,000 to $600,000 range, so they would see a $300 to a $350 increase in their tax bill. And that's really it in a nutshell, unless there are questions.
Chris, go ahead,
Couple,
sir.
thank you. You mentioned that you have a ratio of exempt properties, which helped to kind of come up with that number, the percentage, the increase in the mill. Is that something you have that's available, the ratio of properties by district or by area that we can look at?
That's just I don't have those ratios calculated. That's just an observation to explain why the mill rate's not changing by exactly the same amount in each tax district. But we've never calculated that.
That's definitely something of interest to my neighbors. And then, is this something a person has to apply for, or is this something that's just granted?
Well, a person does have to initially apply for a residential exemption. I would if we increase the amount of the residential exemption, they would automatically get the new exemption.
Oh, thank you.
But there are people, Chris, that don't know this even exists.
Yeah.
So every now and then we find people, I've lived here 5 years and didn't know I could put in for this, so we need to get the message out. Question from Assembly members. Yes, Mr. Steele.
Does your assessment notice identify those exemptions, the senior, the veteran, and so on and so forth, whether or not they have them on them?
No, it doesn't.
Okay, so we have to check with the assessor to find out if those are on
Or online.
Online, it shows up.
Other questions from Assembly members? Mr. Peterson.
Weldon has one.
Mr. Wilton, sir. Sorry, I didn't see your hand. Sorry about that.
I had it up for a minute. Just a question, I guess from the sponsors. What's the purpose of this? Why are we doing it?
Because when we increase the motor fuels vehicle tax, it increased where we have the money coming in from. And the desire was to give a tax break to the moderate homes out there in Anchorage, and so that's the reason for bringing this forward. It's only designed to affect the residential properties, not commercial. You're shifting from one side to the other. That's a choice we made when we brought this forward.
Mr. Chairman?
Mr. Croft?
Yeah, and as another sponsor on it, I'd say that the original at statehood, there was a 10,000 exemption allowed. Later increased to 20, and later the legislature most recently allowed it to 50. And
In 2012.
yeah, in 2012 they allowed us to go to 50. And it's an appropriate part, in my opinion, of the tax structure that hadn't been updated in a long time, hadn't been increased. 10,000 on property at statehood was a very significant residential property tax deduction, and now it's a lot less so. And so, in one way to look at it is we're just keeping that up with inflation, but it does have the effect of having a progressivity to your property tax system that helps small homes and medium-priced homes, and asks very expensive homes to pay more.
Mr. Dunbar.
Yeah, I'll just add to that too for my colleagues who I'm sure have caught this, but just in case and to put it on the record, if we just went from 20,000 to 50,000 and we didn't increase the percentage as well, we would lose a lot of that in effect, and actually taxes would go up for $100,000 for the very for the homes that are worth less than $200,000 or worth less than $100,000 because they're already at that percentage cap at
Right.
10,000 or at 20,000. So you have to do both in concert if you want to have these effects that Mr. Croft is speaking of.
Mr. Steele.
No. I just,
Mr. Peterson.
I was just looking at page 4 of the handout, and I didn't realize we had 58 tax districts. How are they?
I'm not an expert on the tax districts. to be
Set up
honest.
by neighborhoods or?
The tax map, when you look at the tax map, the largest tax districts are 1 and 3, which is almost everything in the bowl except Hillside. And there's a lot of little ones up in Hillside, little limit road districts and that kind of thing. And the same with outlying Eagle River, Chugiak, same idea.
Okay. All right, thank you.
Mr. Falsey.
Mr. Chair, there's a further complication to that. The tax districts are all a consequence of the overlapping service areas. But there are some service areas that we're not sure really have any independent lingering existence, which cause different tax districts. So all the acreage bowl is divided into the tax district 3, which differentiates between the old city service area and sort of the rest of what you think of as urban acreage. And they're taxed at the same mill rate. Those service areas still exist on paper. I don't know that there's any difference between one side of the line to the other, but we're sort of stuck with them just from inertial state. So there are 54 tax districts, but there are probably half of that as actual differential taxing zones, and those are all real changes because of the LRSAs.
And keep in mind, all we're asking the body to do, after the hearing on this, is to send this to the voters. It's not a decision made by the Assembly, it's a decision made by the voters. All we're doing is agreeing to send it to the voters. Chris?
So, yeah, Mr. Falls, you just hit on to something that one of my neighborhoods has long been chewing on, and that is that there are parts of the downtown tax, I think it's District 1, that are basically infrastructure-wise the same as a totally inferior neighborhood, but are taxed at the same rate as the best parts of the downtown neighborhood. And they have long complained of a disparate impact in that scenario. And so if we're going to be reviewing tax districts, it'd be a great opportunity to review some of the ways that we're doing that, because Fairview is taxed at the same rate as South Edition, but its infrastructure quality is the same as Mountain. And so it's an interesting dilemma. But just to speak to Sylvia, who's here from Alaska Hospitality Retailers, the concern was brought up that this does approach businesses with an increased tax, and they are feeling the pain of a down economy, and so it's definitely worth just at least speaking that into the record. So,
That's fine.
thank you.
And so the homeowners struggling to make their house payments.
Mr. Chair,
Mr. Peterson.
Since we have a little time left, thank you, Mr. Chairman. As long as I've been talking to taxpayers and neighbors door to door, one of the largest complaints that I get the most often is about how much they pay in property taxes and that they keep going up. And we have many in our community that are getting to the point where they're planning to retire, or they hope to retire at some point. And some of them are worried that they may not be able to retire here because the cost of living keeps going up, and a lot of that happens to be an increase in their property taxes. So this will give residents an opportunity to vote themselves a tax decrease. And they probably don't get that opportunity very often. So I actually think this is an excellent idea.
Mr. Falsey, and then Suzanne, and Eric.
just one quick footnote as a follow-up to Johnson's last comment. One of the things that we should highlight is that Brian's analysis showing the tax burden shifting over to the commercial properties is not incorporating the offset of the gas tax. So that won't fully reduce the effect of pushing more taxes into that direction, but it will blunt that effect some.
Suzanne?
Thank you, Mr. Chair, and thank you, Mr. Falsey, for that comment at a council meeting last night. That also came up as far as shifting the burden to small business, especially in our community, and those difficulties, and also came up the burden on residential property owners. This is not the topic of today's discussion, but there was a fair amount of support for conversation about a seasonal sales tax. So,
Yep. Mr. Croft?
Following up on both those, is there a combined impacts
It's
spreadsheet,
done
right, that
right
says,
to do that.
with our estimates of the gas
I'll
tax
talk to you
and
about that.
this, here's what it nets out to? Because it's an overlay of those two that we want to communicate. I mean, it's not just the 300-ish, it's something more than that the average homeowner is going to see with the combination of these two measures.
We probably could do that with an estimate, incorporating that additional revenue from the gas tax into an estimate of the mill rate. We'd have to work with those.
It's really just a mill rate
Yeah, it's
reduction.
just a mill
impact.
rate
Yeah.
change. So, and then we could use that new mill rate in this analysis.
I'd like to see that because there are people genuinely, concerned all the way up to upset about the gas tax, and to say, well, this is the trade-off that comes with it. So I know you don't like it, but here's what it produces in combination.
Do we have estimates of the total amount raised by the gas tax? Do we have that?
14 million.
Okay, so we could do that.
I'd appreciate it.
Other questions from assembly members? No questions. This work session over. Thanks for being here.